Hey, what is up guys? Welcome back to another weekly market analysis video. And if you have a better name for this series, feel free to let me know in the comments down below. Anyways, the S&P 500, it is down 1.16% for the past week. And so does the tech-heavy QQQ index. They are down 2%. These are of course no thanks to the uncertainty around the 50 or 75 bips rate hike on the month of September, plus the never-ending COVID lockdown in China. And we saw China reducing their interest rates by 10 basis points or 0.1%. It's not huge at the scale of things, but that just sends the signal that Chinese economy is not in a good shape at all, especially their property market, as shown by their recent GDP slowdown. And the yield curve, the 10 to 2 year spread, which is my favorite leading indicator, is now standing at negative 0.26%. This is a slight improvement from the negative 0.4% last week, but it is still in the negative region. So until it is in the positive region, I will still remain my defensive stance with my money. Now we look at the S&P GSCI index. It is up 3.2% for the past week. This is not good at all, of course, and if you realize commodity prices always counter-react the stock market. When S&P is down, commodity prices will go up. FINRA investor margin debt, there is a slight uptick as of the beginning of July, which means there is a gain in confidence in the market to leverage more than ever. I'm not a fan of margin, more so especially in a 8.5% inflation / recessionary environment like right now. Anyways, earnings update, we look at Walmart. They beat estimates by 8.6%. thanks to an increase in back-to-school sales, lower fuel prices, and they see more wealthier customers actually coming to Walmart to shop. That's telling you the US consumers are actually more wary of their spending right now. Their EPS beat of 8.6% sounds impressive, but it's actually because they have been slashing their profit forecast for the past few months. As you can see, they plunged in May. Hence, analysts actually gave them a lower estimates instead. Now we look at Target, which is Walmart's competitor. They are below estimates by 51%, and this is mainly because they have much more discretionary products compared to Walmart. For example, clothing and electronics. So the consumers are actually behaving the same. They are cutting back on their discretionary purchases and only go for the needs instead. Now we look at Home Depot, which is the IKEA for the US market. They beat estimates by 2%, and they say that this is thanks to a healthy project backlogs and strong sales from professional contractors, which are more resilient than DIY customers like us. So it seems like the renovation and construction projects that have been postponed from pandemic is now doing them a favor, even when there's less appetite for new and existing homes, which means less renovations and furnishings. So I'm not sure how long this will last, because they will come to a point where they clear off all their backlogs, and then there will be significantly less demand. Then that's where probably the headache starts to kick in. Anyways, the US existing home sales report for the month of July, it continued their decline for the 6th month in a row, and it is now currently in over 2-year low. Month over month, there are 5.9% lesser homes being sold. Year over year, there are 22.4% lesser homes being sold. This is definitely not a good news for existing homeowners in the US, but overall, I would say the slower demand will definitely build up the inventory. So when there's more homes up for sale, but lesser buyers knocking the door, that means there will be more pricing competition, which means it will slowly but surely drive down the home prices. What I also think is, since there are lesser people buying home in 2022, that might mean people have more cash to redeploy in stocks or just splurging on cars and whatnot. So in a way, it's somewhat benefiting the stock market as a whole. Now we look at the FOMC meeting minutes, which was released last Wednesday. It's a pretty lengthy and boring document, but I think this extract pretty much summarizes the document. In view of the constantly changing nature of the economic environment and the existence of long and variable lags in monetary policy's effect on the economy, there was also a risk that the committee could tighten the stance of policy by more than necessary to restore price stability. The keyword here is more than necessary. And in simple English, this means that the Feds are still committed to bring down inflation, if that means pushing the economy into a recession. But keep in mind that yes, employment market have been really strong, and midterm election is coming this November, so they probably wouldn't risk throwing their reputation under the bus, at least for now. But Russia-Ukraine war, China's COVID lockdown, These two alone would and could be the two largest hurdle for the Feds to regain the below 4% mark for inflation, let alone falling back to the 2% level again. And that is why you see the 10 to 2 year spread is still negative, because the bond market is still pricing in the probability of a recession in the short term. So for what it's worth, I think it's still too early to celebrate and go all out with buying the dips. Quick pause, you can support this channel for absolutely free by clicking the link in the pinned comment down below, and I will receive a tiny advertisement commission from Interactive Brokers. They are the best brokers out there, so feel free to check it out, and I will continue to make more and better quality video for you guys as a return. Thank you very much. Now back to the video. Now we have the US retail sales report for the month of July, which is important to gauge the spending behavior of the consumers. The overall retail purchases in July is the same as it is in June, so there is no growth or decline in consumer spending. But if you look at this table, the only negative ones from June to July are motor vehicles and part dealers at negative 1.6%, gasoline stations at negative 1.8%, clothing and clothing accessory stores at negative 0.6%, general merchandise stores at negative 0.7%. So if you strip out fuel and auto spending, there is actually a growth of 0.7% in overall spending. This means that because the Americans are spending lesser in their petrol money, they are actually redeploying that cash to spend elsewhere, maybe for food or household items or electronics and whatnot. So for what it's worth, that increase in spending is actually a good sign, because that means there are more money circulating the economy, which means it is a positive contributor to the upcoming quarter's GDP. But of course, there is always a possibility that the number could be distorted by the inflated prices of general goods, so that could be the case as well. Upcoming important dates for this week: on the 23rd of August, which is a Tuesday, we have the new home sales report for the month of July, which tells you how the sales for the newly built homes went. And it is usually a lagging indicator, because usually there will be a hyperinflation which led to a higher mortgage rate, and then only people will start slowing down on buying houses, and then only the data comes in. So in a way, it's just another piece of data that is rather similar to the existing home sales data, so good to know, but not a huge deal. On the 25th of August, which is a Thursday, we have the Q2 GDP data second estimate. I know what you must be thinking. Hey Ziet, I thought last month we already had the Q2 GDP data of negative 0.9%, right? Well, you are right, but just for your information, there are 3 months in a quarter, right? So there are actually 3 GDP data revisions. The first one, they call it the advanced estimate, which is the negative 0.9% we had in the month of July. And second one, they call it second estimate, which is the one that we are gonna see this coming Thursday. And the third one, they call it final estimate, which is what we will see in September. And if you're wondering what's the difference between first and second and last revisions, well, the Feds themselves said there will usually be large negative revisions from the first release to the final release at the beginning of the recessions. So probably that is why they have a monthly GDP data, to make sure it is reflecting the actual world situation. And in terms of earnings, we will also have Nvidia announcing on the 24th of August, which is a Wednesday. And this is also another piece of information that allows us to see how's the demand for the semiconductor sector, or also just the appetite for discretionary spending. Alright, that's all from me. Hope you like this video. Let me know in the comment section down below how I can improve this weekly analysis format. Whether you like more quantity but less deep dive, or you want less quantity but more deep dive into say 1 or 2 specific news. And I will be more than interested to know what's your preference. Alright, thanks for watching. Have a great week ahead, and I will see you in the next one.